welcome back. In our last session, we got our heads around what the stock market is. Today, we're going to tackle its language. You know, all those words like bull, bear, Sensex, and Nifty. It can feel like a secret code, right? Well, I promise it's not. By the end of this, you'll know exactly what they're all about. Let's jump right in.
So, just as a quick reminder, we've already laid the groundwork. We've talked about what the stock market even is, what a share actually represents, the basic idea of how prices go up and down, and of course that big difference between long-term investing and short-term trading. But you know, even with that foundation, have you ever been listening to the financial news and just felt your brain switch off? It's like everyone's using this special jargon that you're just supposed to know. If you felt that, you are definitely not alone. And that feeling? That's what we're going to fix today.
So here's our game plan. We're going to break it all down into 4 easy parts. First, the where, as in, where does all this happen? Second, the scoreboard. How do we know who's winning? Then, your toolkit. What do you actually need to participate? And finally, the market moods. Simple as that.
All right, first things first, the marketplace. I mean, it makes sense, right? Before you can buy or sell anything, you have to know where the shop is. When it comes to stocks in India, there are 2 main shops you need to know about.
First up is the BSE, the Bombay Stock Exchange. This one is the original, the OG. It was established way back in 1875, making it India's very first stock exchange. You can really think of it as the historical heart of the Indian market.
And the other huge player is the NSE, or the National Stock Exchange. Now, it's much newer than the BSE, but wow, it was a total game changer. Why? Because the NSE was the first to bring in the modern, electronic, screen-based trading system that we all just take for granted today. It really pushed everything into the digital age.
Okay, now inside these exchanges, there are kind of 2 different zones. You have the primary market. Think of this like a company's grand opening day. It's where they sell brand new shares to the public for the very first time. You've probably heard of this, it's called an IPO. But after that day, all the trading of those shares between investors happens in the secondary market. So when you hear the news talking about the stock market, they're almost always talking about what's happening in the secondary market.
So we know where the action happens. But with literally thousands of companies, how can we possibly get a quick snapshot of how the market's doing overall? You know, is it a good day or a bad day? We need a scoreboard.
And that's exactly what a stock index is. It's basically the market's report card. Instead of tracking thousands of different stocks, an index just grabs a sample of the big important ones and follows their combined performance. This gives us one simple number that tells us if, in general, the market is heading up or down.
Now, the most famous index for the BSE is the Sensex. When you hear on the news, the market is up 500 points today, chances are they're talking about the Sensex. It simply tracks the performance of the 30 biggest and most important companies on the Bombay Stock Exchange.
And that's the magic number to remember for the Sensex, 30. It's a select group of 30 major companies that together act as a powerful barometer for the health of the whole exchange.
And you guessed it, the National Stock Exchange has its own headline index too. It's called the Nifty 50. And as the name pretty much gives away, it tracks a collection of the top 50 major companies listed over on the NSE.
So the key number here is, 50. It gives us a slightly broader look at the market's health by following 50 of the biggest companies. So it's pretty easy to remember. Sensex is 30, Nifty is 50. Okay, so we know where the market is, and we know how to read the scoreboard. But what about you? How do you actually get involved? What tools do you actually need to have in your toolkit?
Well, it really just comes down to a few simple things. First, you need a guide to get you in the door. That's a broker. Second, you need a place to keep your stuff. That's a DMAT account. And once you have those 2 things sorted, you're ready to go.
Let's start with a broker. Think of a stockbroker as your official gateway to the exchange. You can't just call up the NSE and say, hey, I'd like to buy a share. It doesn't work like that. A broker is the licensed firm that has access and can execute your buy and sell orders for you.
And once your broker buys those shares for you, where do they go? They go into your DMAT account. The name just comes from dematerialized, which is a fancy way of saying they aren't paper certificates anymore. Honestly, the best way to think of it is as a secure digital wallet that holds all your shares electronically.
Okay, so once you're set up and ready, you'll notice 2 prices for any given stock. The bid price is the highest price any buyer out there is willing to pay at that exact moment. The ask price is the lowest price any seller is willing to accept. The actual trade happens somewhere in that little gap between the 2.
All right, for our last section, let's talk about the big picture. Because the market isn't just numbers. It has an overall feeling, a mood. And we have a couple of animals that we use to describe these moods.
I'm sure you've heard these terms before. A bull market is when everyone's optimistic, the economy's doing well, and stock prices are generally going up. A bear market is the complete opposite. People are pessimistic, the economy is slowing down, and prices are generally going down. The easiest way to remember which is which? A bull thrusts its horns up, and a bear swipes its paws down.
And that's it. Sensex, Nifty, DMAT, Bull, Bear. See? They aren't scary, secret words. They're just labels for ideas. And by understanding this basic vocabulary, you've already taken the biggest first step, moving from feeling confused to feeling confident.
And hey, if this series is helping you connect the dots and clear up some of that confusion, maybe think about subscribing to NeuralTarot. That way, you won't miss out as we continue learning all of this, step by step. So what's next on our journey? We're going to tackle a huge and really important topic: understanding risk.
In our next explainer, we're going to dive deep into what risk actually means in the stock market. We'll look at the different kinds of risk, and we'll talk about the fundamental reason why it's an unavoidable part of the whole process. I'll see you then.